Hello and welcome. My name is David Nguyen. Today I will be discussing debt consolidation. Do you know today there are more Canadians incurring debts than ever before in the Canadian history, and more than 50% of them are actually borrowing exceeding the limits. And today I have a very special guest. Her name is Elaine Chan, and she is with Accredited Home Lending for the past 2 years, and she's been in the industry for the past 5 years. And they specialize in hard loan or loans that are declined by the banks, and plus they are familiar with debt consolidation before you file for bankruptcy. Thank you for being here today, Elaine.
Thanks for having me, Dave.
I guess we can start with the basic questions. What is debt consolidation?
Well, debt consolidation is the process of combining multiple loans or liability into one payment. And normally the purpose of this is to have a lower monthly payment and a lower interest rate overall.
Oh, like such as if somebody has the auto loan, credit card loan, or even student loans afterward, and they can actually lump sum all those together for one single loan per month.
Yeah, correct.
Okay, good. Of course, and why is it important to consolidate debts before it's too late?
Well, I find there's two major things. First of all, is you want to know what your debts are, what your current debts are. It gives you a reality check of what you owe and who you owe money to.
Yes.
And hence, having said that, it goes to the second point. It helps you in your future planning. So if you're about to purchase a home or purchase a car, you want to know what your current obligations are without the purchase yet, and what is left versus your income and what your current bills are.
Okay.
So that will tell you what you can afford to buy, because the last thing you want to know is having things and debts and people calling you because you're not paying your bills.
That's right. Why is it important to consolidate your debts before it's too late?
Well, I find there's two major things why it's important to consolidate your debt. First of all, it gives you an idea of what your actual debts are right now. And by doing that, you lower your overall payment, your monthly budget, you work everything out. And it also brings you to your future. If you're planning to purchase a home or purchase a car or any big purchases like that, it gives you an idea of how much you can afford to buy.
Yes.
So knowing what your actual debts right now tell you what you can afford to purchase, because the last thing you want is buying things left and right and not being able to pay them.
Yes.
Right.
Not to mention a peace of mind also.
For sure.
Okay, and then once a person feel like they're in a hole or financial stress, how do they get out of it and before it's too late?
Well, first of all, you need to know exactly who you owe money to. You need to know who are your creditors and how much you owe them.
Yes.
And second is you need to work out a schedule, a monthly schedule that is realistic and feasible. You can't set something out that you can't really do, because that's not going to stick in your plan. So you need to know how much your income is and how much you can afford to pay. And lastly, there's resources out there, individuals or institutions out there that could help you. Let's start with your banks, your local banks.
Yes.
You may have a credit card with your bank, loan, a car payment, and even a mortgage for those who own a home.
That's right.
So rather than having 4 or 5 multiple loans with that bank, you can talk to them about perhaps lowering the overall rate and having a lower monthly payment and lesser loans that you have with them. And second is you can also talk to people who are slightly overwhelmed with bills. They can talk to credit counselors.
Yes.
There's a lot of people who can give you advice, and they can work a schedule for you to maintain. All you have to do is follow, and your creditors will be taken care of.
Yes.
So you just follow paying that monthly fixed payment.
Yes.
And lastly is for those who own a home, you can talk to independent mortgage brokers.
Yes.
Because mortgage brokers are not just there to find you a house or on purchases, but they can also help you refinance your home, use the equity of your home, and pay out higher debts.
Yes.
So that's, I would say those are one of the 3 main resources that you can use.
Yeah, I guess the key here also is that you have to manage before it's too late.
Exactly.
And I guess this is where financial planning help would actually pay off before it's get too late also. And then of course the other one is, how about homeowners? How do they use equity from their purchase or from their home, in order to consolidate debts?
Well, the idea here is when you own a home, is there's such thing as what we call equity, and the equity is how much your value had gone up versus how much you owed, you're borrowing against. Okay, so it gives you the power to borrow against the value of your home.
Yes.
I'll give an example. So if you own $200,000 with your mortgage with your bank, and you have 50,000 out there of credit card bills, line of credits, different bills left and right. What you can do is remortgage your home from 200 to 250, increase your total mortgage amount.
Yes.
But at the same time, you're actually paying off debts that have higher interest rate. So in a lot of times, you're saving money, and B, you don't have to worry about multiple bills.
Okay.
So the idea there is to use the equity, the value of your home, get you a better rate, and save money.
Okay. So, I mean, obviously, there's many advantages to consolidating debts. Obviously, one is being a low payment, two being a low interest rate, and three is if you use it to secure against your property. Obviously, the monthly payments would be much cheaper than like a credit card payment. But what kind of rate can someone expect from consolidating debts?
It depends. It depends on your credit. It depends on how much you're going to borrow against the value of your home.
Yes.
There's a lot of factors that go in, but one thing definitely, it would be cheaper than the 28.9 department store cards or the
That's
average
right.
19% that you're paying against your credit cards.
Yep.
So as we know, mortgage is one of the lowest rates out there to borrow against. So if you do own a home or several property or property, you can use that mortgage and borrow money, keeping either that rate or slightly higher, but at least it's still lower than what you're currently paying.
That's right.
With your other bills.
And still have a roof to live under.
Yeah.
And of course, feed-wise, like, I mean, generally speaking, from all the way from the bank, if you qualify, to somebody like such as your company, which is subprime lending, what kind of fee can they expect for somebody who's starting consolidating debts?
The fee would depends on how much you're going against, like we say. If it's a normal 75%, there might not be a fee.
Okay.
Depends on your credit.
Yes.
But if you're borrowing all the way to 90% or 100% financing, there might be a 3.5%, 4%, even 5.5% fee that has to be insured because you're borrowing against. It has to be insured. You're going over a certain limit of borrowing. So that's the idea of where fees roll in.
Thank you, Elaine, for coming in today and speaking with us about debt consolidation. It was very useful. I hope today's discussion really helped you out, and if you have any questions, you can always contact Elaine at
604-831-9756.